welcome back to the channel. In today's video I'm going to go through which fair value gap you should use if you have multiple fair value gaps when you're trying to, enter the market using the ICT 2022 mentorship model. Sometimes what will happen is, let's just assume that we've taken liquidity, right? So we've come up in the market, and then what we've got is the generic model from the 2022 mentorship, and you've come up, you've obviously, if it pulls back like this, let me just change this so you can see it a little bit better. So let's just say we've got something like this, right? We've, taken liquidity from over here somewhere, and then what's happened is we've come down with displacement. We've got our market structure shift on obviously this candle, and what's happened is we've got a fair value gap around here, and we've also got a fair value gap somewhere down here, and you might also have multiple fair value gaps in and around this leg of price right here. And a lot of people, do get confused when it comes to which fair value gap to get involved in. And obviously, if you're getting involved in this fair value gap at the bottom, the risk to reward is going to be a lot less, because you will obviously be targeting somewhere down here, some sell side liquidity. And if you're obviously putting the stop above this high, the risk to reward will be a lot smaller. And obviously, if we go ahead and enter on this fair value gap up here, the risk reward will be increased quite a lot, right? So what we can do is, if I just go through and show you some examples right here. So first of all, we'll start on Euro USD, and I've got a couple of different currency pairs right here just to take a look at some examples. So as you can see, what we've done is we've just ranged around a lot here. We've built liquidity, engineered liquidity, and then what we've done is we've come down, we've taken the previous daily low, and we've also run liquidity below Asia session. Then what will happen is, once you've done this and you've got your confluences and you've taken the liquidity that you've obviously wanted to see go, what you can do then is you can jump down onto your entry time frame, whether that's the 1 minute, the 2 minute, 3 minute, 4 minute, 5 minute, whatever it may be. Jump down onto your entry time frame, and as you can see, what will happen is you will wait for obviously the entry criteria, which will be obviously the market shift, the fair value gap, and everything like that. So let's just zoom in and see what we've got in this little bit of price action at the moment. So as you can see, what has happened is price has come up, and we've also taken this high right here. So we've got our market structure shift, which is what we will want to see. So we've come down, we've obviously taken liquidity, and we've broke up with displacement. There's clear momentum in the market right here, and obviously we've now got our market structure shift. But what you will notice is we've got multiple fair value gaps. So if I just mark those out for you, we've got a fair value gap right here. We've got a fair value gap right here, and we've also, that looks around, so we've got two fair value gaps right here, right? So when you come to this point, you might think, do I enter here at the top? Do I enter at this fair value gap and cover these lows? Or do I enter at the fair value gap further down? Obviously this is in hindsight, so we can see now that price has actually come back to this one, but there's a reason for this. So what you can do is you can pair this up with a balanced price range. You can pair this up with a breaker block. If you don't know those, there is a much simpler way that you can obviously get involved in the market without actually knowing those concepts. So what we can do is we can take our premium and discount tool, right? Take it from the top to the bottom, or the bottom to the top. And as you can see, price has come back and it's actually tapped into the discount of this leg right here. So if I just mark that out, as you can see, it's come back and it's tapped into this fair value gap, which is situated in the discount of this, price range right here. So as you can see, we can obviously we can set our entry right there, and we can put our entry stop loss just above obviously the candle that does create the fair value gap, which would be this one right here. And then you can target, some buy side liquidity or fair value gap up in and around this area up here. So that's one way that you can do it. And if I just go through and show you another example, so we'll go over onto GBP USD now. And we've got a similar situation right here. So we've got all this liquidity, we've got trendline liquidity here, and we've come up and we've taken Asia high, and as you can see, we've gone ahead and reversed. So if I just drop down onto my entry time frame right now, and we'll see kind of what's going on. So price has come up actually quite far past the Asia high, and as you can see, there's no market structure shift until we get this displacement leg right here. So what you will notice is we get a market structure shift. So for me, I would say that these lows right here, once these lows go, this is our market structure shift, and this is the first sign that we might want to go bearish. So a market structure shift, and then as you can see, this is our displacement leg, and at this moment in time, we've got two fair value gaps. So we've got one here, So you've got a fair value gap right there, and we've also got a fair value gap between this candle and also this candle. So again, what you can do is you can go ahead, get your 50% tool, your premium and discount, and then you can go ahead and choose the fair value gap that is in the premium in this case, because we are obviously selling. So choose the fair value gap that is in the premium of this displacement leg right here when we are looking for our entry. So as you can see, you can just disregard this one. Sometimes what might happen is sometimes price might come back and tap into this lower one, and you might often miss trades. But for me personally, what I think is I'm happy to miss trades as long as I can reduce my stop loss and get a greater risk to reward. And for me, if it comes a bit further up here, and it's much more higher probability if price does retrace into this fair value gap right here. Obviously I've got a much smaller stop loss. If we obviously entered in on this fair value gap, the most logical thing to do would to be cover this high. But if not, if you obviously cover the candle that does put in this fair value gap right here, as you can see, you would have been stopped out of this trade. So to enter and cover the high, so enter on this fair value gap in the premium, cover this high so our stop loss is protected, and as you can see, we pull back in pretty much perfectly. We do stab through it a little bit into this candle right here at the top at the extreme, and then what happens is we do reverse and we go down, and this trade right here would have been quite brilliant if you did hold it towards these lows. It would have been a massive risk to reward trade. But that's one way that I use. Obviously, like I said, you can use stuff like balanced price ranges, you can use breaker blocks, you can use other concepts that ICT teaches on his YouTube channel. But the easiest and most efficient way to do it in the moment, especially if you are trading the lower time frame, the most efficient way to do it is using your premium and discount tool, your GAN box, your fib, whatever it may be. And you can pair this up with like OTE, whatever it may be. All of those concepts do work. But like I said, the most easiest and the quickest way to do this is just to see if we are pulling back into a premium or discount, and then that will obviously reduce your stop loss and obviously increase your risk to reward. So that's one way that I would do it, guys. If you found this video helpful, please leave a like on today's video. If you have any questions, feel free to drop them in the comment section down below. And without further ado, guys, thank you very much for watching, and I'll see you in the next one.